Yeah, this is my first video on financial management. I'll be talking quickly in this introductory part of the financial management. Uh, in this introductory portion, I would like to cover, as you are aware that two faculty members are handling this course, I'll be covering a part of financial management. Broadly speaking, I'll be covering the following five heads. I'll be talking about in this part of the course cost of capital, I'll be talking about capital budgeting, working capital management, capital structure, and dividend distribution decisions. So, in this part of financial management course, I'll be covering these five portions. So, obviously, cost of capital is going to be my first topic. But before I start talking about cost of capital, I need to explain to you how I will be going ahead with the course. And before we actually talk about cost of capital, let me lay some basic foundation so that I can talk about cost of capital in detail. As I begin, the very first thing which I would like to talk to you that which or what type of organizations we are usually referring to. If we talk about these organizations as you are finding it here, sole proprietorship firm is the firm where owner is one. I have one more slide which gives you a brief idea, number of owners, liability, legal status and all. Then we have got a partnership firm which talks about if the owners are more than one, but it's not a format of company, but just owners are more than one, as you're finding it here. I'll come back to company. Then we have got government organization, which can further be divided into three subparts. We have uh, we have government companies, and we have got statutory organizations, and then we have got some departments under ministry, so we call them departments which are directly working under ministry. So these are three types of government organization. Then we have got NPOs. NPOs can also be of three types. NPO can be a trust, it can be a society, and then we have got something known as Section 25 or Section 8 company. And then we have got a plethora of international organizations which covers UNESCO, WTO, WHO, UNICEF and all. If you look at, these are the possible six types of organizations which are existing in the country, in India, but this is something which we have not talked. This when we say government organization, when we talk about, then as I was talking, there are some government companies, I should call it. We have got government companies. So if I can link this, I mean these can be linked to this. I'll elaborate on companies. So what we are finding is Business organizations which we talk about in MBA programs, they are of six types. But out of six types, this is the company for which we quite often talk about. So company is the point of attraction for us, and we'll talk about it. Companies are again of two types. I can say that companies are of two types. So companies are also known as we can call it JSC, joint stock companies. I'll elaborate why I'm calling it joint stock. Then we have got private limited company and we have got public limited company. So what we are understanding that unless until anything else is mentioned, we would be talking about joint stock company. Now here point of discussion is why do we call it joint stock company? Because let me show you this. As you are finding that liability, this liability is the most important thing here. What is happening? Liability is unlimited in case of a public sole proprietorship firm, and second we are talking about partnership firm. So here what you are finding that liability is limited, means if there is any problem comes and company is unable to, let's say, repay the loan, then those who are the owners of the company, they will not, the personal properties will not be at stake. Rather, the properties or assets held by the organization, they will be used to settle the liabilities. That's why we call it limited liabilities. But that's not the main point of discussion. When we say that we would like to talk about a company, what is happening when we talk about a company in a company, if you just feel the difference in all six, the basic difference is ownership. As you're finding it, ownership is the basic difference. So what we are saying when we are talking about a joint stock company, then in joint stock company liability is limited. This is good thing. But more than that, what is happening? That the ownership in a company, if you look at, then ownership is divided. If I, let's say, draw this, that this is the ownership, then you will find that this whole ownership of a company is divided in some unit. That unit is known as shares, or if I just refer to a US stock market, then I will talk about, I can call it stocks. So what I'm saying, the ownership, this is the ownership. So this has been divided. This has been divided in number of shares. So what is happening? So shares can be divided as can be described as, this is unit of ownership. So two good things. In a company, the liability is limited. Second good thing, that there usually what happen in a company setup, the number of owners are many. So what is happening that in case of sole proprietorship firm or partnership firm, the number of owners are less. So they can dictate the terms, but that cannot happen in case of a company. But if you, as you find here, you have got private limited, public limited. In private limited companies, again, you have got lesser number of people, those who are owning the share. Owners are between 2 to 200. But when we talk about public limited company, then the situation is entirely different. So what we are saying that this is the most important. This is the most important. This public limited companies are the most important part. So now I can say whenever we talk about a company in India, we are talking about usually public limited company. But when we say company, we are incorporating the two. No problem. So this is the first thing. When we talk about a company, we are referring to a joint stock company. This discussion may not be much relevant what is finance because the course has already been started. Let me talk about three basic principles of financial management or corporate finance. This is important because when we say three important principles, then this principle says that when money is procured, this is the, usually this is the order in which we normally go ahead and talk. So we start with obviously this first. This first is nothing but procurement of the fund. Money is procured. Then we move to this, money is invested. And then what happens when money is procured, money is invested, then it is processed and organizations or companies produce some goods or services, it is sold. If you exclude from the sales the cost part, whatever you get, that can be termed as profit. And from the profit, part of the profit is given to the shareholders or the owners of the company. That is known as dividend distribution decisions. So what happened? These are the three principles of financial management. Principles or decisions. First, most important decision which is taken by any company or finance manager of a company is to procure the money. Second is where to invest the money, and third is what to do when money would have been procured, money would have been invested, and profit would have been derived by the organization. These are the three important principles of decision making which is done in financial management. Now I come back to this discussion of ownership. As you are finding it here, in a company, there are many shareholders. So what happened when we talk about objective? Let me talk about the goal of business organization because ultimately goals are important. What are the goals of business organizations? Yeah. So when I say goals of business organizations, goals. Just a sec. Yeah. So I'm talking about goals of business organizations. Goals of, I'm calling it business organization, but right now I've defined that whenever I say business organization, I'm talking about a company. So popularly, there are three, goals which come into picture. First is profit maximization. Second is shareholders' wealth maximization. And third, which is more relevant nowadays, with CG, corporate governance. So now if I say what is the goal of business organization, then this is the goal. This is the goal of business organization. What is the goal? Goal says this is the goal. So it means profit maximization is not the goal. The wealth of the shareholder is not the goal. Rather, shareholders' wealth maximization along with corporate governance is the goal. Let me elaborate. What do we mean by when I say shareholders' wealth maximization? The share price into number of shares, which is technically nothing but market capitalization. And this is share price into number of shares will give you market capitalization, which is the wealth of the shareholders. Let me give you the argument. Suppose the share price goes up. If share price goes up, what will happen? Market capitalization will go up. So these two are linked. As share prices goes up, market capitalization goes up. So if a company performs good, share market values that better, and accordingly, the wealth of the shareholders goes up. But if I limit myself just to this, then that's not a great idea. Because if I just look at this, shareholders' wealth maximization is a narrower concept. This is the most narrow concept. It is no more valid. This is valid but partially. Rather, this is something which we pay attention to. Shareholders' wealth maximization with corporate governance. Let me give you one more idea before I start my discussion on cost of capital. So right now what we are talking about, before I talk about cost of capital, let me talk about what is capital. So for us, it is important to understand that uh, when we say cost of capital, I have to start the topic cost of capital. So when I say cost of capital, uh, in cost of capital, the important thing is obviously the cost. The cost is important, but before we talk about the cost, the important thing is we have to talk about the capital. What is capital? What do you mean by when we say capital? So the best source to understand capital is look at the balance sheet, because balance sheet will give you the clear picture. If I have to elaborate what is in a normal way, what do you understand, or what is capital? So capital can be understood whatever a business procures the funds, total funds. If I say look at what are the requirements of capital, that could be two: short term and long term. So short term and long term requirements of the money is there. All the requirement is known as capital. You can also, I understand this in this way, that money when it is coming. So what is happening when money is there in a company? Money comes by two channels. First is we need capital to run the show, whether it is short term, long term, or by selling goods and services. So this is not what we are referring to right now. Rather, what we are referring to this. So to run the show, whatever money is required by the company, it is known as capital. So now the discussion of capital, if I just try to link this thing with the financial statements, then I'll say capital discussion of capital is done in balance sheet. On the other hand, discussion on capital is done on the balance sheet. On the other hand, discussions on sales is done on profit and loss account. So I have tried to link this with the help of financial statements. So just to understand what is capital, it is good to talk about the balance sheet. I'll quickly show you a box diagram of the balance sheet. Look at it. This is the capital which I'm saying. Liability is all the money which comes in. So if I look at the liability side of the balance sheet, then if I exclude the current liability, then whatever is left, that is known as capital. Now the issue is this capital, what I'm talking about, this capital, or let me say that this whole, it is comprised of two broad sources: owned and borrowed. Owned capital and borrowed capital. Now, when I say that I have to know the cost of this, I'll obviously take this topic in the next discussion. But this is the thing, that what is the cost of this capital? Because there are no free lunches in this world. If I have to run the show in a company, I have to have the money. And if I have to have the money to run the show, as I said that this capital has to be there. So it means that money has to be arranged. And there are no free lunches. When money has to be arranged, then it has got a price. That price will be cost of capital, We will obviously take this issue in the next session.